10 rules of successful investing. Why do some investors build massive wealth while others struggle despite earning good incomes? The answer isn't luck, it's following a few simple rules consistently for decades. Today, we'll cover 10 timeless investing rules that can help you become a better investor and avoid costly mistakes. Rule 1: Start early. The biggest advantage in investing isn't money, it's time. Now let's assume investor A starts investing at the age of 25 and invests 10,000 per month for 10 years. And investor B starts at the age 35 and invests 10,000 per month for 30 years. Assuming both retire at age 65 and the returns that we have considered is 12%. So by the time they reach 65 years of age, investor A, who has invested only for 10 years starting at the age of 25, his investment is 12 lakhs, whereas the amount has become 8.35 crores at the age of 65. Investor B, who started at the age of 35 and invested for 30 years, his investment is 36 lakhs and the amount that he has made is 3.53 crores. Investor A invested only 10 years but started early. Investor B invested for 30 years and invested 3 times more money. Yet investor A ends up with more than twice the wealth because of the power of compounding over a longer period of time. The extra 10 years of compounding allowed investor A money to grow dramatically, demonstrating that in investing, time is often more powerful than the amount invested. Starting early beats investing longer. The earlier you start, the harder your money works. Rule 2: Invest regularly. Don't wait for the perfect time. Nobody can consistently predict market highs and lows. An investor who invests 10,000 every month through SIP continues buying during bull market, bear market, crashes, recoveries. Over time, consistency beats prediction. Think long term. The stock market rewards patience. Rupees 10,000 invested in the Nifty when it started would be worth around 2.5 lakh today. That's the power of long term compounding, not finding the next hot stock, but giving your investment enough time to grow. Many investors fail because they expect quick profit. Successful investors think in decades, not days. Rule 4: Buy great businesses. A great company can create wealth for decades. Look for companies with strong brand, consistent profit, competitive advantage, good management. Examples include TCS, HDFC Bank, Asian Paints, L&T. Quality matters. Rule 5: Diversify. Never put all your money in one stock. Even great companies can face challenges. Instead of investing 10 lakh rupees in one company, spread investment across banking such as HDFC Bank, ICICI, Axis Bank, Kotak Mahindra Bank, IT, TCS, Infosys, HCL Tech, Wipro, Tech Mahindra, FMCG, companies such as Hindustan Unilever, ITC, Nestle, Britannia, Dabur, Healthcare, companies such as Sun Pharma, Divi's Lab, and index funds such as Nifty 50, Nifty Next 50, Nifty Midcap 150, Nifty Small Cap 250, Nifty 500, which covers the total market. Diversification reduces risk. Rule 6: Ignore market noise. Every day there is news, elections, wars, interest rates, recessions. Most of this noise doesn't matter for long-term investors. Investors who sold during major market crashes often missed the recovery. Focus on business performance, not headlines. Control your emotions. Fear and greed destroy wealth. Investors often buy when prices are high and sell when prices are low. Successful investors do the opposite. Remember, the best decisions are made using logic, not emotions. Keep cost low. Small fees can destroy large amount of wealth. A difference of 1% annually can cost lakhs of rupees over decades. Assuming you do an SIP of 20,000 rupees per month for 30 years and the market return is 12% annually, You have invested total of 20,000 into 12 into 30, that is 72 lakhs in 30 years. And you end up with 7.06 crores. Now suppose you are paying small fee, which is also called as expense ratio. For regular fund, the fee is 1.53%. So you will end up with 4.26 crores instead of 7.06 crores just by paying that 1.53%. That means you lose 2.8 crores to the mutual fund company and to the agents. Instead, if you buy a direct fund, you are paying 1% as expense ratio. So you will end up with 5 crores and you will lose 2 crores to mutual fund. And if you, instead of direct fund, if you buy index fund, Nifty index fund, they charge 0.4% as fees. So you will end up with 6 crore rupees and you will lose 1 crore rupees to the mutual fund company. The difference wasn't stock selection, it was fees quietly stealing crores through compounding. This shows why long-term investors pay close attention to expense ratios. Even a 1% or 2% annual fee difference can compound into crores of rupees over a 30-year investing journey. Low-cost index funds help investors keep more of their returns. Continue learning. The market changes. Successful investors keep learning, read books, study businesses, understand financial statements, learn from great investors such as Benjamin Graham, Warren Buffett, Peter Lynch. Knowledge compounds just like money. Stay invested. The biggest gain often comes after the biggest declines. Many investors miss wealth creation because they leave the market too early. An investor who stays invested through cashes often benefits when market recover. Time in the market is usually more important than timing the market. Successful investing is not about being a genius. It's about following simple rules consistently for many years. Wealth is built slowly, patiently, and systematically.